The US stock market is insanely overvalued. Most people aren't thinking about this because they're making money. But there's a small group of people who sit at home thinking this is not normal. Now in this video, I'm going to show you exactly why and how the stock market is overvalued and exactly what you need to look out for. You're going to get my exact thoughts in a few stocks that I am watching. And I want to start off by showing you the Buffett indicator. You guys can see that we are far above the danger zone. In fact, we're well above the extreme danger zone. Now, the Buffett indicator, which again is exactly what we're looking at here, is the total value of all US stocks plus the United States GDP. So when this sits at 200%, which is exactly what it's doing right now, it means that the stock market, which is what you're looking at up here, is worth roughly 2 times the entire annual output of the US economy. And it basically suggests that things like the S&P 500 and singular stocks are very expensive relative to the real economy. And historically, when the ratio gets extremely high, like it is right now, well, then future returns tends to be weaker, right? We can even see it here. So for example, right here, we hit 160% and the US stock market actually ended up tanking, let's see, about 24%. So again, we saw a massive bear market here from 2021 to 2022, and it doesn't even come close to where the Buffett indicator is currently sitting. But that's not all that tells us the US stock market is insanely overvalued. What we're looking at here is the CAPE ratio, which again right now sits just south of 40 at 39.45%. Now this means that investors are currently paying about $40 because of, again, the CAPE ratio being near 40 for every $1 of normalized earnings. This is bad because it means that stocks are again very expensive compared to their long-term earnings power, and you can see that during other crashes like in 1929, this was only sitting at 29.93, and we are in fact approaching the levels of the dot-com bubble in the year 2000, which was sitting at 43.77 before the again massive crash. The problem looking at indicators like this is not that the US stock market will crash tomorrow. The problem is future returns are usually poor from these levels forward, and the market has less room for bad news, and you'll understand why this is extremely important later in this video. Now, this is another valuation metric, which you are probably familiar with, called the S&P 500 price to sales ratio, or again, just the price to sales ratio. Now, this is currently sitting at 3.67, okay, and that means investors are paying $3.67 for every $1 of company revenue. That's expensive because revenue is before cost, debt, taxes, wages, and more. Now, this is especially bad when yields are high, which, by the way, they are, right? Looking at the US 30-year yield here, we actually hit levels we hadn't seen since 2007. So the US 30-year yield topped in at 5.2%. It has dropped a little bit since then, but again, is still very elevated. Now, when we have high yields, which we have right now, investors can get a safer return from bonds because how much bond pays is dependent on the yields. So stocks need to justify their high valuations with strong earnings growth. And so with a price to sales ratio of 3.67 and the high yields that we're currently seeing, the market is basically saying pay a huge price for sales while safe bonds already pay well, and that makes stocks a lot more vulnerable to repricing. Another scary factor is the fact that the US stock market is ignoring things it shouldn't. For example, inflation at 4.2%. So inflation jumped from 2.4% in February, which was when the US-Iran war initially broke out, to 4.2% in May of 2026. So again, that is almost a 2% increase in just a couple of months. Now, this happened while the interest rates were also very high, still sitting at 3.75%. The Fed has not been able to do anything with this because, again, inflation sitting at 4.2% means they certainly cannot cut the rates because that would make inflation go even higher, but they also can't hike the rates because the economy was under so much pressure from the actual conflict, and so they were essentially stuck. Those are not conditions where a stock market should rally. And in fact, when we do see high yields, we typically see lower stocks. That is typically how it goes. The higher the yields, the lower the stocks. Now, here's why that typically happens, right? So when yields go up, which they have certainly done this year, well, then bonds become more attractive, as I already said. Right now, they're sitting at 4.9%, which means you can get bonds paying you 4.9% pretty much risk-free. And so people would much rather do that than hold riskier assets like stocks in any normal market. We're just not seeing that, right? Simultaneously, the dollar typically strengthens, which again means people would rather hold cash as it is just paying better and, pivot away from stocks because they don't see the need to take this unnecessary risk. Inflation, and especially inflation expectations, typically go alongside yields, or yields respond to the inflationary expectations. And so the higher the inflation, typically the worse it is for the actual stock market. And again, as a result of all of this, of course, stocks usually go down. We just haven't seen that. The reason we haven't seen that is simple, right? I want to show you this chart, which is the SPX 2-year normalized return, and then we compare it to the SPX excluding AI stocks on a 2-year basis. So with the AI stocks, the entire stock market on a 2-year basis is up about 42%. But if we exclude the AI stocks, it's only up 16%. And this is without factoring in the war, because the only reason why the stock market didn't crash was again due to AI stocks lifting it up. So this would in fact be closer to break even or even negative without the AI stocks, because the US stock market would in fact have reacted to all the negative headlines. So we are actually looking at a stock market that would potentially have been negative this year had it not been for all the AI stocks. Now, this can be a problem, and I'll tell you why. We have seen massive spending on AI infrastructure this year, and the larger companies, so the 5 big companies, Microsoft, Alphabet, Google, and Amazon, are forecasting a combined capital expenditures of about $730 billion this year, according to JP Morgan. Now, the problem is that AI has become the market's main support beam, right? But keeping that support beam standing now requires hundreds of billions of dollars in spending before investors know if the returns will actually justify it. So we're essentially seeing an immense amount of spending before the returns have justified it, just like we saw in the year 2000 during the dot-com crash. And there's actually been recently a picture-perfect example of exactly this, and that was with Broadcom. So in one singular session, right, Broadcom crashed nearly 20% and is since then down nearly 30%. Broadcom is a company that has otherwise done tremendously well. You can see that their second quarter revenue of $22.19 billion missed the estimates of $22.27 billion. And so a small miss in expectations literally caused the entire stock to crash 20% and even continue beyond that. Now, that is despite on an annual basis, Broadcom continues to beat their revenue. And again, despite the very, very small difference in their actual revenue versus estimate. So again, this goes to show what can actually happen to AI stocks, even if they miss expectations just a little bit, just because of how high the expectations actually are. And we're seeing more stocks being priced this way. For example, Palantir. The PS ratio for Palantir is incredibly extreme, right? Investors are paying more than 50 times the current revenue, meaning for every $1 Palantir makes in sales, the market is valuing the company at over $50. Now, this only makes sense if Palantir keeps growing extremely fast, keeps expanding margins, and becomes one of the dominant AI software companies in the world. And the forward PS ratio is actually the scary one because it already gives Palantir credit for future growth, and the stock still looks expensive. What the stock market, in my opinion, actually needs are rate cuts, but that becomes problematic, and that, confuses a lot of people given the fact that oil has actually broken out of its consolidation and is currently trading at $73 a barrel, which is actually back within very, very healthy parameters. So for months, right, it was trading between $90 and $110 a barrel, which is severely elevated, but it has broken out on a singular headline and is actually looking really healthy. The main problem is the fact that inflation has not had time to catch up yet, and yields have not reflected any lower oil prices. The underlying economy still looks pretty strong, right? Looking at the job market, the unemployment rate remains steady at 4.3%. The non-farm payrolls are also looking pretty healthy, at the last one being 172,000, and I believe we have a new one in the coming days. And because of that, because the job market and such actually looks pretty strong, the Fed is expected to hold the rates steady. But markets are pricing in roughly a 70% probability of a rate hike by September. Now, remember how overvalued we definitely confirmed the stock market is? I just want to show you the trigger behind a lot of the crashes we've seen throughout history. So for example, in 1987, a rate hike was one of the primary catalysts for the actual crash, and the stock market was incredibly overvalued. We saw it again in the year 2000, so the dot-com crash, in 2018, and in 2020. One of the most brutal ones actually being 1929. And so given the fact that the stock market is incredibly overvalued and how much perfection all the AI stocks are priced in for. And we've already seen that it is starting to crack, or it definitely can crack. And again, the fact that the AI stocks are holding up the vast majority, if not literally the entire US stock market, it is not unreasonable to assume that a singular rate hike could in fact cause the inevitable correction. The problem is, right, people have not really had a reason to sell their stock yet, right? People are making money, they're happy, and today a lot of the market is being driven by algorithms, right? And so when the market continues to make new all-time highs, the algorithms are buying more. And so that just drives more purchasing power for the actual stock. And so you need a catalyst that will make people sell when, historically that could be a rate hike, which again, there is a 70% probability of that happening by September. Now, what we would need is for the Fed to pivot away from a rate hike and go more towards the potential that we could see a rate cut. For that to happen, we would almost certainly need a weaker job market and, of course, a reflection of the lower oil prices within the actual inflation rate, which can take a couple of months given the fact that we need multiple CPI reports. Now, the problem is, how do we get the unemployment rate higher while the inflation is falling? Well, one of the things that could cause a weaker job market is, again, interest rates being this high for that long. If they remain this high, I believe that it will have an effect within the job market that will start to weaken. And again, we could see rate cuts being brought back onto the actual table. Now, let's talk about a few stocks that I see a great hold in, and one of them being ASML. Now, ASML actually broke out right at the beginning of this year. And since January of 2026, the stock is actually up close to 67 or 69%. Now, this sits at the bottleneck of the entire advanced chip supply chain. And so it's not betting on one AI app, one model, or one software company like a lot of other stocks. It sells the machines needed to manufacture the most advanced chips in the entire world. And so if the AI compute demand keeps growing over the next decade, which again, everything is certainly priced in for, well, then ASML sits closer to the infrastructure layer than the hype layer. Right now, the stock has a market cap of $755 billion. So again, a relatively high market cap and also pretty expensive. But again, I believe it could be a good hold for the long run. And I also believe that we could actually potentially see a stock split within this stock, which again, historically can drive a lot more capital and investors towards that very stock. The next one being Broadcom. And I know you think I'm crazy, right? This has already proved, this was literally the stock that proved that the AI chain could actually fail. So why in the world would I bet on this? Well, the primary reason why I want to bet on it is because the only reason why it crashed was because of ridiculous expectations. In fiscal year 2025, they reported a record of $63 billion in net revenue, which is a 24% increase compared to the $51.5 billion revenue reported in fiscal year 2024. If we then take a look at fiscal year 2026, well, the first half of it, well, then it's already reached a $41.5 billion revenue. And so if this continues throughout 2026, well, then 2026 will also significantly outpace their revenue in 2025. And so it's a very growing company with actual numbers backing it up. Lastly, I feel the need to mention Marvel. Marvel is another AI stock that I believe, and not only me, by the way, could do great numbers in the near future. Now, this was actually one of the few stocks that crashed alongside Broadcom, not as aggressively as Broadcom, but recently Jensen Huang, which is the founder of NVIDIA, actually came out and said that Marvel is primed to join the $1 trillion club. And so they are backed by the largest company on a global scale. And if we actually take a look at the market cap, it's sitting at $259 billion, which means if the $1 trillion market cap is within parameters, well, then this has significant room for growth and is therefore, in my opinion, a great long-term hold. So again, my primary issue is the rising expectations, the fact that we are needing to spend hundreds of billions of dollars, yields being high, inflation being high, interest rates being high, yet the stock market continues to go higher. And one stock has already proved that this can in fact crack. Do they miss expectations? And so a rate hike could in fact make investors realize what's actually going on underneath all of this. And that's when it can legitimately crack. And so best case, we don't get a rate hike. And I'm most definitely not saying that the entire stock market will crash, but we are simultaneously experiencing the interest rates, increasing in Japan, currently sitting at 1%, which if we zoom out on a 10-year scale, you can see that for decades, they kept it at 0. Japan is one of the largest, actually it is the largest foreign holder of US treasuries. And so when their trade starts paying again, which it's doing right now at 1%, well, then they might start to sell their US treasuries and move back to their own markets. And a lot of US investors have taken yen-backed loans because again, they could get them interest free, but now they're going to have to pay interest on those loans. And so what they do is that they also sell their US treasuries to pay off their yen-backed loans. China is also moving away from the US. And so overall, I think that the future could be very ugly if things doesn't change. Now, again, I'm not saying that we're going to get a repeat of the year 2000, but I am saying a correction is almost inevitable. And given the metrics that I've shown you in this video, that correction could be quite aggressive. But again, if it comes down to that, well, then it is what it is, and you should view that as nothing more than an opportunity. In fact, I am hoping that it happens. So again, ladies and gentlemen, I want to thank you for watching this video. If my voice has been a little bit off, I am incredibly sick. I've caught the worst cold, but I felt the need to record a video, and so here it is. Thank you a lot for watching this video, and please, if you enjoyed it, subscribe to the channel and like the video. It's entirely free, and it would help me out a lot. This is a brand new channel, and I appreciate the support. So again, thank you for watching, and I hope to see each and every one of you within my next video.